picture, a nice picture of our building. Quick disclaimer, these are basically general comments. You should talk to a tax professional about how they apply to your specific situation. So in a nutshell, that's what that says. So I guess a quick overview of myself. My name is Kyle Meisner. I'm a manager here at Cordell, Neher Company. I've been here for 3 years. I've been in public accounting 17 years, I think. I sort of lost track somewhere along the line, but a few too many tax seasons will do that to you. My practice is primarily focused in the tax area. I do enough bookkeeping and A&A to be vaguely dangerous, but my main focus is tax. Joe, you want to talk about yourself real quick?
Sure. My name is Joe Violet, and I am a supervisor at Cordell, Neher Company. I do remember exactly how many years I've been accounting. This is my 11th tax season that is just getting underway. And I, like Kyle, pretty much just do tax type stuff. In particular, I do a lot of kind of larger S-Corp, 1065 partnership type of returns, really kind of have a focus on business tax myself.
All right, thanks, Joe. So we'll jump right in, starting with the employee retention credit. So the big headline here is that it was still available in 2021. And if you didn't get it and you qualify, you can go back and amend your 941s or 943 and get that. Same thing goes for 2020. So 2021, you're looking for a 20% reduction in revenue in quarters 1 through 3 compared with the same quarter in 2019, or operating under a reduced capacity due to a government shutdown. So a lot of businesses qualified first and second quarters because we were still operating under those capacity reductions. So if you do qualify, the credit is 70% of the wages paid, up to $10,000 per employee per quarter. So this can be pretty massive if you have a lot of employees. And then the other way that you can qualify is if you started a business on or after February 15th of 2020, you would automatically qualify as a COVID startup business, but only for the 3rd and 4th quarters. And then the same rules apply with the 70% of wages, up to 10,000 per employee per quarter. But the maximum credit for those COVID startups is 50,000 per quarter. And then 2020, the revenue reduction was 50%, same quarter 2020 versus 2019. And the wage credit was 50%, up to $10,000 per employee per year for 2020. So a lot less credit in 2020, but still certainly valuable, especially for those with a lot of employees. So if you haven't taken this in 2021 or 2020, you definitely should go back and look and see if you qualify, because this has been pretty large for a number of our clients. Downside here, like it says, is that the employee retention credit does reduce wage expense, which in effect makes it taxable income to you. And these have been taking a while to come through. We're starting to see, as of the end of the year, they were starting to come through for those 1st and 2nd quarter 941s that we filed in the spring of 2021. So finally starting to see these kind of start to shake loose, but the IRS, as I'm sure everybody's heard, is really far behind. So that taxable income thing could be a little bit of a cash flow crunch, because you may have to pay some tax on something that you're not going to see for 6, 8, 12 months, depending on how far behind the IRS gets. But it doesn't look like they're making a ton of headway and catching up. So PPP Forgiveness, the application is technically due, for lack of a better description, 10 months after your covered period ends. And really all that means is that you have to start paying interest on the loan. You have longer than that to actually submit that application, but you will have to start paying some interest after 10 months from the end of your covered period. And then PPP forgiveness is taxable. So employee retention credit, PPP forgiveness is not taxable. Employee retention credit is taxable. PPP forgiveness and those EIDL grants are not taxable. And if you're a pass-through entity, an S corp or partnership, they give you basis as well. So they're the best of all worlds from a tax standpoint. Free cash that you don't have to include in taxable income. And despite the IRS's best efforts, whatever expenses you pay with those are still deductible. So truly not taxable on the PPP forgiveness, which was a pleasant change from what the IRS originally had said. So this was really this Infrastructure and Jobs Act this past last fall, and this was really the only bill that really affected taxes at all, the only one that passed anyway. And it really wasn't super impactful. It did terminate the employee retention for Q4, except for those COVID startups. And there's some new reporting requirements for digital assets, so cryptocurrencies. And Joe's going to talk a little bit more about what to look out for in the cryptocurrency area.
Thanks, Kyle. So about a couple years ago now, the IRS got a new commissioner, and kind of one of his major goals that he stated from the beginning is trying to cut down on people not reporting taxable income, really trying to get the revenue up from the IRS by going after people who haven't reported income over the years. And one of the real major ways that they're trying to reach this goal is by trying to really focus on cryptocurrency, because they felt, and probably correctly, that there was just a lot of underreporting going on in this area. A lot of people trading in this area, making money, and not necessarily reporting any or all of the gains that they were making. So this has really become an IRS focus area over the last couple of years, so much to the point that on the front of your 1040 tax return, they even ask you a question now about whether you've been trading crypto at all in the current tax year. So if you are involved in any sort of crypto type transactions, it's really important to know kind of that it's just like any other sort of stocks or other type of reporting that you would have. You really need to have all your activity, your sales from the year on the tax return and being reported, or else the IRS is really going to go over that, and possibly even retrospectively, once they can potentially prove transactions that have happened. So kind of going along with that, the 1099 reporting standards for like a Coinbase or a Robinhood or somewhere where people are trading crypto, those standards have been updated starting in 2022. So hopefully the documents you receive from wherever you're trading your crypto are a little bit better and more like a brokerage statement, 1099. But even that has its problems, because crypto often transfers between different wallets and things like that makes some of the 1099 reporting a little bit of a mess. So I guess kind of the gist on the crypto stuff is that it's really an IRS focus, and you really want to make sure that you're reporting all your stuff properly. And if you're somebody who is doing anything that's pretty complicated, like mining or something, you really should be having a tax expert or somebody taking a pretty good look at that stuff, just to make sure that you're staying in compliance. And there is some software and some other things that can help make this tracking and tax reporting easier if somebody feels like they're a regular crypto trader. I don't know how many of those we have in the Wenatchee Downtown Association, but if there are any additional questions on crypto, feel free to ask. So like Kyle mentioned before, 2022 wasn't a huge change for tax law. We've had some pretty significant changes over the last couple of years. So, I mean, for us, it's a welcome break. Probably for others, it's a welcome break too, to not have to take on too much more new information on the current tax year. But listed on the screen, you can see a few small highlights for things that have changed in 2022 that could potentially have an impact. NOL carrybacks being eliminated, child tax credits kind of reverting back to the 2020 levels instead of they're a little jacked up there in 2021. There's kind of been more energy efficient home improvement credits that have expired, and there hasn't been as much of a push to renew some of that type of stuff. And that now mortgage insurance premium deductions are not allowed. But none of these things are major. Could have a small impact for individual or business taxpayers, but nothing too crazy for kind of changes happening in 2022 overall. So tax brackets, they're indexed for inflation right now, and they're scheduled to go up after 2025. If you are familiar with the previous tax brackets, you can see that they have gotten, again, a kind of a nice little bump in the current year for the standard deductions. As a whole, rates still remain fairly close, and tax rates remain fairly close to kind of all-time lows if you look at it from a historic perspective. So over the last couple of years, I feel like a general recommendation to clients and stuff has been to not be afraid to pay a little tax now on some of your longer term type stuff, because it is pretty likely that, especially as we see the national deficit continue to rise, that's not really going to be able to be fixed without having some sort of tax increase. So I would keep a lookout on the tax brackets and some of those things, and I would expect them to increase as we go along in the next handful of years and beyond. But for this year, nothing too crazy, just a little bump for inflation indexing and a little bit bigger of a standard deduction.
So moving on to depreciation expense limits for 2022, you can take section 179 depreciation up to a little over $1 million. The total investment limitation is about 2.7 million. So if you purchase more than $2.7 million of section 179 eligible property, then you won't be allowed to take any. But as long as you're less than that, then you can expense up to that $1.08 million. Also for 2022, we still have 100% bonus depreciation allowed. And with the Tax Cuts Job Act a couple years ago, they took out the requirement that purchases be brand new to qualify for bonus depreciation. So, before 2017, if you had purchased like a used vehicle, it wouldn't have qualified for bonus depreciation, but now it does. So that's pretty nice, because there's a ton of flexibility around depreciation expensing in 2022 still. So bonus and 179 both sort of accomplish the same things, but they get there a little differently. So 179 gets recaptured if the business use of the asset falls to 50% or below. So you could trigger some taxable income just by not using your asset in your business, but not necessarily getting rid of it. 179 allows you to expense as much or as little of each asset as you'd like, where bonus depreciation is applied by asset class life. So if you bought 5 computers with 179, you could decide how much of each computer you wanted to expense. With bonus, you would have to expense all of the computers or not. But if you bought 5 computers and put into service some property, some qualified improvement property with a different class life, you could use bonus to expense the computers and depreciate the qualified improvement property. So there is some flexibility on what gets bonus and not, but there's less flexibility with bonus than 179. And then bonus depreciation isn't limited by taxable income, but Section 179 depreciation is. So what that means is you can't create a loss with Section 179. And that's probably more applicable at the pass-through level, where you can have bonus depreciation sort of get caught up because it would create a loss, but maybe the individual owners could use the deduction. So just something to be aware of as you're thinking about how much depreciation to take. And sometimes it's nice to have that, but Section 179 carryover instead of a net operating loss carryover, because it offsets a little more of income, but there's sort of a lot to consider when you're deciding how much depreciation to take and what type to take. And on top of that, like Joe mentioned, tax rates now are historically low, so you may rather pay a little bit of tax now than save that depreciation for down the road when we think that tax brackets are going up. So a couple other expensing options around new asset purchases: the de minimis election, the small taxpayer safe harbor, and the routine maintenance election are all ways that you can expense newly purchased assets without even having to worry about depreciation expense. So the de minimis election allows you to expense items under $2,500 per item or per invoice. The small business safe harbor allows you to expense improvements to buildings as long as they're less than 2% of the basis or $10,000. And then routine maintenance allows you to write off things that you pay for reoccurring activities you expect to perform. So like painting your business or anything like that, things that happen, once every 10 years or less, you can just write off. So really, the big takeaway here from these things is that you can dial in your depreciation and other expensing options to get your taxable income, hopefully to a number that is palatable and a number that you like. There's a ton of flexibility still in 2022 with all these options to write off new asset purchases. So Section 199A, this is the qualified business income deduction, still around for 2022. This is a 20% deduction, 20% of your business income. If your income is over $315,000 for married taxpayers or $157,500 for others, then there's potentially some limits. Rental property does qualify for this as long as you have separate books and records. Somebody or another spends 250 hours working on the property, or if you have more than one, you can group them together to get to that 250 hours. And that 250 hours doesn't have to be the taxpayer. It could be a plumber, a landscaper, and an electrician combining to meet that 250-hour requirement. And then you do have to keep contemporaneous records of the time that you spent and the activity that you did. So this can be a pretty big benefit for small business owners. An extra 20% of net income just coming off the top. Estate and gift taxes, not a lot of changes here. The federal limit starting for 2022 is a little over $12 million. So far, the stepped up death basis remains. As you'll see in a little bit, that had sort of been on the chopping block, but as of now, we think we know it's still there, and we think it's going to stay. Washington State estate exemption stays at just under 2.2 million. So that's something to keep an eye on, because most folks don't have a federal estate problem, especially a married couple. That 24 million is a pretty big hurdle to get over before you start having to pay estate taxes. But $2.2 million, we do see that one come up a lot more. So if you think that you're going to be close to that, you should talk to a tax advisor or an attorney and come up with some strategies to get around that. Some gifting works really well. There's no Washington State gift tax, so that's been a really effective strategy to mitigate the Washington State estate tax. So just kind of keep an eye on that, and hopefully the federal limits stay where they're at. But we think there may be some changes here down the pike, and we'll talk about that in a little bit. So I'll turn it over to Joe again to talk about the Washington State capital gains tax.
Yeah, so I guess when I said that there wasn't too much new in 2022, that was more of a federal statement, because Washington State has this new capital gains tax, and I mean that's a pretty big change for Washington State as a state that doesn't really have any individual personal taxes. Overall, though, I think this one wasn't targeted at the kind of average citizen or average business owner. It was really targeted to try to get extra money from really large sales of stock. So like it says on the screen there, it's a 7% tax, but it's only on long-term capital gains over 250,000. And you only have to file the form if you owe any tax. So for anybody in Washington State who didn't have 250,000 of long-term capital gains, there's no new requirement for filing a tax return or anything like that. It's only for the people who owe tax on this new measure that became effective just a few weeks ago for this current tax year. There's some pretty extensive exclusions. Some can get a tiny bit complicated, but basically the gist being that any gain from the sale of real estate or real property that might in other situations be considered a long-term capital gain isn't and is excluded here in the Washington State capital gains tax. Kind of the other big one, and the one that might be a little more applicable here, is gains from the sale of a qualified family-owned small business. So if you have kind of a smaller family business and you're planning to sell, you might want to, and you're expecting to get a pretty large gain, you might want to check in with a tax advisor, look into these rules a little bit just to make sure that your business might qualify for this exemption, or maybe you have a little bit bigger of a business you're thinking of selling and expecting a pretty large gain. It's something to think about now too, because that could potentially have some impacts with this tax. And then there's kind of other situations that are always excluded from this tax, like charitable donation, capital gain property and assets in retirement accounts and things of that nature. I guess another thing to think about here is that this is just for individuals and pass-through entities. So if you're running like a C Corp or something like that, you're still kind of already paying that tax. So it's just, this new tax is just for individuals and any kind of flow-through income from an S Corp or a partnership, that capital gains that are coming to individuals that might be over this threshold. So here's a little bit more in detail on the real estate exemption. It covers all the real estate transferred, basically, that's with a legal title and filed as public record. So pretty much, as you can see, it pretty much includes any sort of even standard-ish deal that you would see for land or property around this area. Land and fixtures, mobile homes, trailers, floating homes, improvements on leased land. And then this is maybe the key one. It's sales of interest in an entity that directly owns real estate. So even kind of those real estate partnerships and stuff and such still can qualify for this capital gain relief. So the Tax Cuts and Jobs Act, effective January 1st, 2026. You might recall this is the big kind of Trump tax stuff, and it's kind of, as you can see, it's pretty extensive list of things that are set to kind of disappear in 2026. So at this point right now, anything can change with a lot of these things up until then, and there's going to be a lot of legislation over the next handful of years. But this type of stuff is kind of why we say we expect brackets and other things to kind of go up over time. As of right now, they're set to revert back to kind of 2017 levels in 2026. But and most of these, I mean, some of these are good for taxpayers, some of these aren't. But for example, like the state and local tax deduction limitation, not as big a deal in Washington, but that one would that deduction limit would get removed. Alternative minimum tax could potentially return, which could be a headache. And they're talking about dialing down bonus depreciation and qualified business income deduction as well. So some of these deductions that Kyle talked about in fairly detailed a few slides ago are great and should definitely be utilized if possible now, but it's definitely not something that you can plan on being there for sure 5 years from now or 10 years from now or anything like that.
Okay, so I'm going to try to read this slide. I'll have to squint a little bit. It's a little small, but really, the crux of this slide is what I wanted to show you, is that we think that there's going to be some changes coming, but we don't exactly know what it's going to be because they keep changing what they propose. So just as an example, the corporate tax rate, originally Biden's proposal was to raise it from 21 to 28%. And then there was a bill, a proposal that went through the House Ways and Means Committee, which changed that increase to 26.5%. The last bill that the House Democrats passed, they removed that corporate tax rate increase. And so you can see that there's a lot of things that have been in flux. The corporate tax rates, the individual tax rates, the surcharge tax on high income individuals, that 20% qualified business income deduction is on the chopping block here. Originally, capital gains rates were what they were talking about changing, but aside from the surtax on high income individuals, it looks like we may have escaped that one. So there's a lot here at play. Those estate tax limits, I've seen anywhere from $5 to $12 million, depending on what they decide to do. There was talk of getting rid of the stepped up basis at date of death, which would be a pain, and it would also be a lot of work for taxpayers. So It does look like there's going to be some changes at some point based on what Congress and the president is telling us that they'd like to do. We'll see ultimately what that looks like, but it makes tax planning pretty difficult right now because we don't know necessarily what the final rules are going to be. At this point, there's a pretty good chance that 2022 won't change. Not that it can't change or that it's impossible that it will, but we're a little ways in, so probably any changes for 2022 would be taxpayer friendly, but it's entirely possible that they could change all the rules for 2022 retroactively. So fingers crossed 2022 sort of stays with what we have or goes to something that's more taxpayer friendly, but it's very, very likely that in 2023 we'll see some substantial changes. And if nobody does anything, we know that there will be substantial changes in 2026. That's when that Tax Cuts Jobs Act, most of the provisions that we got there back in 2017 sort of expire. That was those things that Joe was going through. So unfortunately, a lot of changes are coming and we don't exactly know what they're going to be. So here is a quick summary of the Build Back Better bill. This was the last thing that the House passed. So like I said, no change to the estate or gift tax provisions, including step up, which is pretty huge. Those could be costly, and getting rid of that step up could really be a record-keeping nightmare, because that means that if you inherit a house from grandma, you're going to have to figure out what she paid for it back, way back in time. So that could be time-consuming and painful for taxpayers, in addition to being potentially more expensive. They're talking about a surcharge tax for those with AGI, adjusted gross income over $10 million. Probably doesn't affect most people. The 20% qualified business income deduction was removed in the last bill. And interestingly enough, they increased the state and local tax deduction up to $80,000 for individuals, $40,000 for estates, trusts, and those folks filing separate returns. Currently, the limit as imposed by the Tax Cuts and Jobs Act is $10,000. So that's an interesting quirk of this legislation. Like I said, a lot of changes coming that we know about, and a lot of other changes may be coming that we don't know about. So tax planning these days, it's tricky because we don't know what the rules are going to be down the road. We do anticipate the tax rates will go up. They're historically low now, so really, really good chance that they're going to be higher, maybe substantially higher going forward. With that, we'll open it up for questions.
Thank you, Joe and Kyle. We did have a question around the capital gains tax. It says, how will the capital gains tax be reported?
Joe, you want to take that one?
Yeah, so the capital gains tax for Washington, I'm blanking on the name or the number of the form, but basically it's an entirely new form, and it would be only filled out by people who would owe tax. So if you didn't have over 250,000 of gains, you wouldn't have to worry about it. But if you did, there's kind of a new small tax form where you'd have to fill out your information and send it in to the state of Washington. I don't have the exact number of it, but it would be just kind of like it would be separate from your federal tax return or anything. It'd be something you'd be specifically filing with the state of Washington.
Awesome, thank you. I don't see any other questions in the chat box. I did record the presentation, so I'll share that out to whoever registered, and I'll post it on our YouTube channel. Thank you both so much for providing all of this information and doing this for us every year. You guys are amazing, and I wish you so much luck during tax season. I hope you guys stay busy. Is there anything else? I don't see anything else. So I'm going to go ahead and just close this out. Thank you guys again so much.
Yeah, thanks so much for having us. And we'll make
Yeah.
slides available to you too if anybody needs them.
Awesome. Thank you. So I'll share your information out with everyone and the video as well.
Okay, thank you.
Thank you, Rose.
Thank you. Have a great morning, everyone.